Good morning, everyone. Welcome back to the Ever Forward Mindset Podcast. We're here live at Freedom Fest 2026 in Las Vegas, Nevada, right here at the Main Street Media Network booth. I am your host and its founder, Michael Rebello of the Ever Forward Mindset Podcast. I'm a 20-year-old entrepreneur who chose entrepreneurship over the traditional college path, inspired and driven by my goal to retire my mother to help other Main Street Middle Americans just like her learn about and invest in multifamily real estate, other asset classes to obtain financial freedom and also time freedom, and to also think outside the box a little bit. But here's the thing, though, ladies and gentlemen. We have IRAs, your 401ks, and all these accounts. You're putting money into them, but what do you do after that? Like, what do you do with that wealth that you've been trying to save for all these years? How can you tap into it? I can't speak on that as much as Nick can. And when I connected with Nick, I'm like, this is the guy that I need to talk to. So, Nick, thank you so much for coming on to the show, my friend.
Pleasure to be here.
Absolutely.
Appreciate you having me.
Yeah, absolutely. So, Nick, you and I talked a little bit about you and your company, what you and your company does with retirement accounts, with your clients, but tell the audience for a little bit what you do specifically, and what is your company, and what services do you provide?
Yeah, so we are Grose Wealth Management, that's my last name, and we're an independent financial advisory firm based in Northern Virginia,
Okay.
But we've got clients all over the country, and our main clientele we're bringing on lately is pre-retirees, so someone that's built up wealth so far over the years, and they're getting ready to step into retirement within the next, call it, 1 to 6 years. The biggest thing that we try to help people with is, obviously, one, we're going to manage the investments to make sure they're set up for growth while still being able to provide you retirement income to live off of. But at the same time, we're also helping not just in the investments, but on the tax strategy side, the insurance strategies, if that's needed, like long-term care or life insurance, and then the estate planning as well to make sure that your money, when you're gone and all your assets, goes to your children and grandchildren or charities and churches in the smoothest, most tax-efficient way possible without creating the big headaches we all hear about with like probate and dealing with the courts for years after someone passes away.
I love that. And I love the fact that you brought that up because there's like, for example, we invest in multifamily real estate. We invest in apartment complexes. And people, they invest in cash or, they just do the regular investment, but they're not tapping into the 401k and the IRAs, their retirement accounts they've been saving for years. So how do people get their retirement accounts wrong? Like here, let me give you an example. They save for so many years. They go for their 401k, and then here's the thing, maybe they get a second job and then their 401k is just collecting dust. What are some of the biggest mistakes that you see with retirement accounts that people are still doing right now?
Yeah, I'd say the biggest mistake, it's kind of two parts.
Okay.
For someone that's still in the wealth building years, so say before age 60, one of the biggest mistakes is I see that people only put money into like the pre-tax 401k or TSP or IRA. So they're lowering their income in those years when they put money in, and then when they take it out in retirement, that's all going to come taxed as ordinary income again. So the reason that's a big problem is people could build up a ton of wealth just in that one bucket, but once they get into retirement and they need to start pulling out money each year to live off of because they're no longer working, if it's all just in that one bucket of pre-tax money from a traditional 401k, TSP, IRA, then that's all coming as ordinary income. So you don't have any flexibility in retirement to decide, I'm going to pull a little bit out of this pre-tax bucket, a little bit out of this taxable brokerage account bucket, a little bit from some real estate cash flow, and a little bit from a Roth bucket. If you've got multiple buckets that are all taxed in different ways to pull from, you've now given yourself so much more flexibility in deciding each year in retirement how much money you want to give to the government.
Absolutely.
If it's all in one bucket, you don't have that flexibility, and you're forced to pay a lot more taxes than you could have otherwise if you would have built up those buckets earlier on.
Right. It's kind of like the proverbial don't put your eggs in one basket.
Yep.
You want to be diversified. Ladies and gentlemen, I talk about this all the time. Diversification is key. Because if you put all of your money, like, for example, you've seen it with the market swings, the real estate crash, when everyone puts their money into one particular market and they lose it and they go, how could this be? Well, don't put your eggs in one basket.
Exactly.
And that's why you want to have a diversified portfolio. But for you, Nick, I kind of want to rewind all the way back. How did you even get into this field or industry? Were you brought into it? Did you build yourself up to this point? Like, what's your story? What's your background?
No, that's a good question. So growing up, my dad is a financial advisor, and I work alongside him now. So I always saw him running his business as a independent financial advisor my whole life.
Yep.
And so I grew like a pretty big passion for it. Come middle school, high school, I got pretty nerdy and deep in the weeds of economics and finance.
Okay.
Liked studying that stuff for fun. So I kind of always had that as a main goal for myself. And right after college, I played a couple of years of hockey overseas in Europe. But after that, then when I started my real professional working career, I did a couple of years in financial regulatory consulting.
Okay.
And just to kind of get my feet wet working with a more structured company before going on the independent side to where I am now, joining alongside my dad as a financial advisor. So that was kind of my path to getting there.
I love that. And I love that it's a family business with a family history. It's kind of like me and my mother working together in multifamily with Everforward Capital Partners. It's like, just keep it in the family. And, it's always that little inspiration there. But, all right, back to the main core. Let's talk about wealth management, right? Let's say someone's kind of going iffy on their 401k. Like, let's say someone of my age or a little bit older, and they're kind of going, should I start saving for a 401k? Because there's rumor around on social media and a lot of other gurus that are saying you shouldn't do a 401k, you shouldn't do an IRA, but let's cut down on the noise and just say, okay, what should we be actually doing? So from your perspective, Nick, should people still be investing in a 401k to leverage it later on, or should they be just putting into different asset classes all in itself?
That's a great question, and you touched on it exactly with the don't put all your eggs in one basket.
Right.
And that can be taken to different levels. So you have the don't put all your eggs in one basket in terms of don't put all your money just into one individual stock, right? Because that can, and historically companies do, go bankrupt. So
Absolutely.
That's a huge amount of risk. So we want to diversify that way by buying hundreds of thousands of stocks through diversified mutual funds and ETFs. But then there's also the side of get into possibly some real estate exposure if you know the industry well and can get access to it and like working in that side of things. That's another different aspect than your stock portfolio. And then you also have the diversification in terms of buckets of money, because they're all taxed in different ways, what I touched on earlier. And when it comes to someone like what you said around our age, that's trying to build wealth for the long run, it's about getting yourself set up now for success so that down the road you have flexibility in deciding how much you want to give the government each year. And it's by building up these different buckets of money that are taxed in different ways. So it's not only just put all your, say you can save 20 grand a year or something, right, based on your income. If you put all of that just into your 401k, you're only building up that one bucket, and it's going to be taxable when you take it out in retirement. Instead, it could be a lot wiser to put a chunk into the 401k pre-tax, a chunk into building up your Roth IRA, and another chunk into a taxable brokerage account.
Okay.
Each one of those are taxed in different ways and can serve different purposes. The Roth and the pre-tax 401k, those you can't touch them until you're 59 and a half years old or older.
Yeah.
So those are kind of stuck until then. The normal brokerage account, that stuff, you can think of it like if you were to buy a property of real estate.
Yeah.
You could always sell it 5 years down the road, 10 years down the road, take the money and run, make some capital gains on it. That's the same thing as a taxable brokerage account. That bucket of money, the growth of it is going to be taxed at long-term capital gains rates. So not bad, like 15% for most people.
Okay.
And then you can also access that whenever you want. That could be a fund you use for another sort of rainy day fund, or buying a second home down the road, buying that beach house. Like that money can be accessed whenever. So you need to be building all three of those buckets in tandem while you're in this wealth accumulation stage of your life.
Interesting. And, I like the fact that you touched upon that. It's like, start slowly building it out. Don't dump it all. Like, you actually want to build that foundation first, because I've seen people where they just go. Well, have you actually thought about that plan? Because when you invest or when you save money, you got to think, okay, this isn't like, today money. This isn't, the next day money. This is what's going to happen in 3 years. What's going to happen in 5 years. Like, I'll give you a great example. Nobody predicted a pandemic was going to happen in late 2019, early 2020, and people were just shelling out money. But that's kind of what you have to, unfortunately, predict. It's like, all right, if I have this amount of money, what is my wealth going to look like in 5 to 10 years? And that's where you figure out where are my investments right now.
Exactly.
And unfortunately, I see that mistake happen often. Again, I'm sure you see that too, where you kind of go, well, I understand you have this amount and you want to get to here, but what are you doing consistently through that time? You want to reverse engineer it.
Exactly. That's 100% spot on. And it's the small steps. It's like all these self-help books of improving at something. Like if you want to get better at a sport or learn to speak a language or play an instrument, it's not about practicing super hard for 1 week, 8 hours a day. Like that'll do something, but if you just then fall off the wagon and give up for the next 6 months, like you're not going to make any progress.
Right.
Investing works the same way. It's just doing little small actions over and over consistently, and those have compounding returns.
Absolutely.
In wealth building, it's like literally compounding returns, but in other things like the learning a sport or a language or an instrument, you get the compounding, improving skill over time.
Yeah, and the point is you have to put the effort in, you have to do the research, and you actually have to, reach out. Because a lot of people, what they want to do is to manage their wealth on their own. I'm like, no, don't do that. Like, reach out to a professional that you know, like, and trust to say, like, hey, I want to do this. I want to get to here, but I don't know what to do with this. And that's where people like you or investors come into play and go, well, if you want to get to here, we need to figure out what this is first. And I kind of want to dive into that for a second, like real estate, stocks, crypto, like there's a lot of investments out there. But for you and your company, what has been the concrete investment that you all have seen so far that helps to either maintain wealth or to at least build it to help them get to where they need to be? So what have you all been seeing?
Yeah, that's a great question. And obviously, just for compliance purposes, I'll say a disclosure like nothing I say here should be taken as investment advice.
Right.
But on that note, what we do is we look at the last 120 years of stock market data, which are freely available out there, and what that data and white paper research shows is the simplest and arguably most effective way to build wealth in the long run, and that's not necessarily picking and choosing individual companies and trying to beat the market year after year, because at the end of the day, it's pretty well statistically impossible to be beating the market consecutive years in a row, and as you extend that timeline, it just gets harder and harder. So what we're doing is not that sexy or flashy. We're investing money in diversified stock funds, US and globally, hitting the different sides of diversification of stock like companies. So you have large companies and small companies. You have value companies and growth companies. And we're getting not just all the eggs in the S&P 500 only, which is US large cap growth. We're diversifying into some international, diversifying into value companies that are paying dividends, and diversifying into smaller companies that can have a little more risk in the short run, a little more volatile up and down, but in the long run, those factors of smaller companies and value companies that aren't as sexy and flashy as the big tech names everyone knows about.
Yeah.
Those historically over 100 years of data do have a little more volatility up and down, but they do get paid off with slightly higher returns in the long run. So we want to try to capture that for our clients that we're working with.
Absolutely. And it's the longevity and the long-term gain and fundamentals. It's a delayed gratification game. Yeah. Like if you look like, for example, the 5-day, the 1 year, the 2 year, like it may look bad, but once you start to go into 5 year, you do realize that you start to get like a gain. It's like all of a sudden you go from red to green. And it's like, interesting. I didn't even see that. It's like in the first like couple of short periods of time, let's say a year or 2 years, it may not look like, okay, I could have just invested somewhere else, but actually in the long run, it's actually more beneficial. Mm-hmm. And unfortunately, that's where people jump off the bandwagon or the train. They're like, okay, I haven't done anything, or, it hasn't gone anywhere. But you have to realize that the market is a living, breathing thing. It will change, it will swing, but you have to figure out what is that end goal. Like, for example, for real estate, we don't just do fix and flips. We hold for 3 to 5 years. Mm-hmm. And we do projections. You and your company, we do projections, right? To figure out, okay, where's this wealth going to go? Where's the cash flow going to go? Equity management, annualized rate of return, all of these things. It's that long-term play. And I wish I could keep telling people, listen, just stick it out for the long run, because you'll love it in the long run. Because you have people that want their cash flow, they have people that want
double their
equity.
money in 2 weeks, right?
Yeah, it's like they want it quickly, but you have to realize that this is a game, and you have to stay in the game and play the game correctly in order to get to the actual finish line. And I'm sure you see that a lot with with the market swings and everything else. But just to wrap up our episode really quick, I'd like to dive into your head a little bit of what you and your company are seeing. So right now, there's been a lot of swings, with the war in Iran, prices with oil and the stock market going haywire and everything. But to chop down all of that noise, to chop down the headlines a little bit, what are your company seeing for like maybe next year, the next 2 years? How do the markets look like for investing? Like, where are things going? Are they looking profitable? Is there like a swing? Are we in a market low, a trough, or a rise? Like, talk to me. What are we seeing?
No, that's a great question, and one that I get asked at least 2 to 3 times a week, I'd say.
Yep.
And the funny thing is, what I will try to guarantee is that within the next 6 or 7 years, I guarantee we're going to have a big market crash. because we always do, every 6 or 7 years. So that's a guarantee. It's going to happen. To know when that's going to happen is such a difficult thing to time. Timing the market's like trying to time the top and get out right before it drops and then get back in at the bottom of the drop is so close to impossible. And if we're in Vegas right now, right? So people are out playing casino games, and some of the best table odds games you can get, the house still has an advantage. You can get like a 48% chance against the house on like craps or blackjack or something. Yeah. The house has the advantage. That's why they want you to keep playing as long as possible. They're going to win in the long run because the percentages work like that. In the stock market, it goes up about 70% of the time. If you could go to Vegas, like any casino game, and there was a 70% chance you're going to win, people would play that nonstop.
Absolutely.
So in terms of projection of the market in the next like 1, 2, 3 years, people have been saying that this AI boom in tech is being super overvalued right now, and we're going to hit the crash. People are saying that a ton right now. People are also saying that a ton last year, and 2 years ago, and 3 years ago.
Right.
So who knows when that's going to happen? I know I don't. And to try to play the odds of a 70% chance it's going to keep going up, 30% chance we're going to take a dip, I just got to play the odds game. And it's like you said, it's the small little actions of compounding growth. So continually sticking to the plan and making sure for our clients that the people that are actually living off this money in retirement right now, we need to make sure that we're prepared for this next crash.
Absolutely.
It's going to happen. I don't know when. But when that does, we need to make sure that our investments are set up in a way so that when that does happen, we don't have to sell everything at the dip. We've got a good reserve there in some short-term conservative investments to be able to withstand that.
Right.
So that's my, hopefully that somewhat answers your question. I can't give you an exact prediction.
Oh, it definitely is. Yeah.
That's how we see the market, and that's the game we're playing, is with a much more longer-term view.
Absolutely. There's always a long-term play in the delayed gratification game.
Delayed gratification. You said it, and that's exactly what this is. It sounds like the same thing in real estate, same thing in the stock market, same thing with just overall life, just trying to get better at something. Yeah. You do need to delay that gratification.
That's right. And Nick, one last question. How can people reach out to you and your company to learn more about what services you all provide? How can they research and learn you and just connect with you?
Yeah, so I'm on many social media platforms, YouTube, LinkedIn, Facebook, TikTok, and then our website is grosewealthmanagement.com. So Grose is my last name. And that's where people can find us. Our website kind of explains it all. We're just a small family office. We've got my dad, myself, and then my sister is our operations manager for our clients. So real proper family business going on, and our clients, my dad's worked with some of his for 30 plus years since he's been in the business, and I plan to do the same for the new clients I've been bringing on since joining.
Awesome. Well, thank you so much for sharing that. Ladies and gentlemen, you heard from Nick himself. If you want to check out Nick and also his social media platforms along with his company as well, check the video description below and the podcast description below so you can follow Nick and his works. And you can also check out the website there as well. Once this is published as well, you can go directly to our website and connect with Nick directly on the episode description and also his profile on our website. And ladies and gentlemen, build yourself better and bigger every day. Live better, live bigger. Always move ever forward. Invest smartly. And Nick, thank you so much for coming on and sharing your wisdom. I know I learned a lot. I know everyone that's listening right now and is watching has learned a lot. So Nick, thank you again, my friend.
Really appreciate it. A lot of fun.